In this module, we will discuss about the international interest rates. Each currency carries an interest rate. It is like a barometer of the strength or weakness of an economy. If a country's economy strengthens, the prices may sometimes rise due to the fact that the consumers become able to pay more. This may sometimes result in a situation where more money is spent for roughly the same goods. This can increase the prices of the goods. When inflation goes uncontrolled, the money's buying power decreases and the price of ordinary items may rise to unbelievably high levels. To stop this imminent danger, the central bank usually raises the interest rate. When the interest rate is increased, it makes the borrowed money more expensive. This in turn demotivates the consumers from buying new products and incurring additional debts. It also discourages the companies from expansion. The companies that do business on credit have to pay interest, and hence they do not spend too much in expansion. The higher rates will gradually slow the economies down until a point of saturation will come where the central bank will have to lower the interest rates. This reduction in rates is aimed at encouraging the economic growth and expansion. When the interest rate is high, foreign investors desire to invest in that economy to earn more in returns. Consequently, the demand for that currency increases as more investors invest there. Countries offering the highest ROI by offering high interest rates tend to attract heavy foreign investments. When a country's stock exchange is doing well and offer a good interest rate, the foreign investors are encouraged to invest capital in that country. This again increases the demand for the country's currency and value of the currency rises. In fact, it is not just the interest rate that is important. The direction of the movement of the interest rate is a good pointer of demand of the currency. After studying this module, you shall be able to know what interest rates are prevailing world over, know why interest rates are high in some countries and low in others, know why interest rates are high in India as compared to developed countries, to know which one is the safest country to invest your money. Let us first begin with the world interest rates. The world interest rates table reflects the current interest rates of the main countries around the world set up by their respective central banks. Rates typically reflect the health of individual economies, as in a perfect scenario, central banks tend to rise rates when the economy is growing and therefore instigate inflation. Rate cuts, on the other hand, are a way to stimulate a struggling economy. The table includes actual rates, latest policy changes and the date of upcoming meetings decisions for the major ones. Next, we will discuss the countries with highest interest rates. Even the very best interest rates in the US don't come close to the highest interest rates in the world. Federal fund rates have been consistently low between 0 and 0.50%. Since December 2008, and interest rates for saving accounts and checking accounts have been low as well, with current national rates at 0.06% APY for savings and 0.04% APY for interest checking. Despite these all-time low interest rates, there is still some money to be made out there. You just won't find it anywhere near the US. Here are the countries with the highest interest rates in the world and information on how inflation plays a role in these rates. Interest rates today, the highest interest rates in the world. While a savings or money account isn't considered safe money in some of these countries, since money is only as safe as the entity backing their promise, it is growing to see what your money could earn in other parts of the world. Here are some countries that currently offer the highest interest rates in the world on 1-year time deposit accounts, or what we refer to as CDs. Inflation rates and the US are included for comparison. As the table shows, currently Argentina offers the highest interest rates of 29.5% on 1-year time deposits. Like our CDs, money must remain in these various accounts for a predetermined amount of time before the depositor is eligible to withdraw the principal deposit and earned returns. Common returns were 3, 6, 9, 12 and 18 months. Next is how inflation factors into high interest rates. The safer things are the lower interest rates are likely to be and vice versa. Chartered financial analyst Chris Gorjandelis of Exchange Capital Management said, in unstable environments, the value of the currency might be unpredictable and might not be worth tomorrow that is worth today. Because of that, people tend to spend money as soon as they get it, which is one of the contributing factors to inflation. To combat people's desire to immediately spend money, the government or money authority might raise interest rates, or monetary authority might raise interest rates. Raising interest rates sends the message that it's better to hold on to the money as you could get it back with a lot of interest in the future. Gorjandelis gave the following example. Imagine a situation where inflation is running at 20% on an annualized basis. An individual can reasonably assume that a unit of cash today will essentially buy 20% less in a year. In such a case, it makes sense to spend all of their cash today. However, if the government steps in and says, if you put your money in the bank, we'll pay you 25% in a year, the calculus changes. All else being equal, a rational investor will recognize that if they deposit their cash today, they'll come out with 50% more cash in a year even after inflation. The act of saving money has a further knock-on effect. It takes cash out of circulation. Less cash in the system chasing the same amount of goods essentially helps to cut down on the original problem of inflation. Moving on to discuss why interest rates are high in India as compared to some developed nations. First, inflation expectations. By rule, interest rates have to be above the inflation rate. Otherwise, the lenders will not lend money. Usually, the long-term interest rate is about 2 to 3% above the inflation rate. India historically had inflation above 6%, while in developed world it is about 2%. Thus, long-term interest rates in India are typically above 9%, while in the developed world it is about 4%. Second, availability of capital. If there is a lot of money coming in for investment, the interest rate goes down. US and Europe get a lot of investments from abroad, like Chinese and Japanese governments buying their bonds. And this extra money pushes their currency up and interest rate down. India gets comparatively less inflow through bonds. Third, currency movements. Higher the interest, higher the inflow of foreign money and a stronger currency. Countries that fear a large drop in their currency strength will avoid reducing the interest rate. India's RBI worries about a drop in rupee, while countries like Japan and US will not mind their currencies going down a little. Additionally, there is one more factor that accounts for the huge difference between rates of interest in India and in developed countries, that is, social security benefits. Most developed countries provide pension to their residents post their retirement, whereas in India, pensions are available broadly to government employees and the military forces. So, if the interest rates are decreased, people will get discouraged to save money for their future in provident fund accounts, pooling money in FDs, which by the way is already very less, and less money in the banking system of the country is dangerous for the economy at large. Now we will discuss about the safest country and its interest rate. Usually interest rates in safe countries are really low. In Switzerland, for example, bank deposits pay less than 1%. The same is true in Japan. In Sweden, interest rates are 1.5% and in the euro area, interest rates are about 2%. But in Iceland, one of the safest countries in the world for doing business, the central bank currently has its overnight lending rate at 12%. Things are unexpectedly decent in Iceland now, with the exception of Ireland. Iceland has the world's fastest growing developed economy, and Iceland is offering investors a great chance to earn big returns on their cash. You might be surprised to learn Icelanders enjoy the world's longest life expectancy and one of the world's highest incomes per person. Crime is almost non-existent there. It's probably because everyone has a job. Implausibly, less than 3,000 people in the entire nation were jobless in the third quarter of 2005. In short, you should never worry about your money there. It's because this country may be the safest country in the world in which to do business. So the question is, if Iceland is such a safe country, why interest rates are so high? The answer is actually pretty simple. Iceland is extremely scared of inflation. Iceland has had serious trouble with inflation in the past. In August 1983, inflation in this country reached over 100%. That's a level you'd expect in some sort of banana republic, not in one of the world's wealthiest countries on a per capita basis with an AAA rating on its debt from rating agencies Moody's. When that kind of inflation set in, it wreaked havoc on the economy. The government has since committed itself to never allowing that to occur again. So today, the central bank in that country targets inflation. Whenever inflation approaches 4%, the central bank slams on the brakes and starts raising interest rates. For most of 2003 and part of 2004, the central bank had set interest rates at 5.3%. But now, like in the States, a housing boom has set in. Prices have soared even quicker than they have in the States. That asset inflation is being compounded by the high price of oil, causing the price of goods to rise. It's a double whammy, and it's now to the point where analysts are predicting inflation of 5% in Iceland in 2006. Of course, the central bank wants to prevent that from happening at all cost. So they are keeping rates extremely high. This situation presents a great investment opportunity for us. High interest returns with extremely low risk. There is an even easier way of taking advantage of Iceland's high interest rates. A 3-month Icelandic krona CD. When you buy a 3-month Icelandic krona CD, you agree to deposit your money in a krona denominated bank account for 3 months. At the end of that period, the CD expires and you get your money back plus interest. If you prefer to keep your money in krona, simply roll the CD over for another 3-month period. The risk lies in the exchange rate. If the Icelandic krona should fall against the dollar while you own the CD, your principal will decline in the same proportion. Of course, if the krona gains by 3%, your principal also increases by 3%. Whatever happens to the exchange rates, you still receive the interest no matter what. But the most important thing to remember is money will be attracted to Iceland as a direct result of the high interest rates found there, and that should support the currency. Up till now, collecting these high safe returns wasn't possible without buying direct in Iceland. The good news is Everbank has just introduced the Icelandic krona CD to its product line with a yearly rate of 8.24%. This CD is a great place for your safe money. All you have to do is fill out a form and send Everbank your money. The minimum investment is $10,000. Everbank is a $3.6 billion company with over 1,500 employees nationwide. So if you don't have to worry about dealing with any dodgy foreign brokers or salesperson to make this transaction. Let us now summarize our discussion on this module. The differences in real interest rates across developed economies remain curiously large and persistent. Canadian consumers, for example, will always have to pay more to borrow than US consumers. Japan, for all its over-leveraged fiscal affairs, taps debt capital markets on easier terms. Its bonds cost more than hail Norway. It is because bonds are essentially a form of insurance that is country specific. Bonds issued in the currencies of larger economies are comparatively expensive simply because they insure against shocks that affect a larger portion of the global economy. If you buy a US dollar denominated bond, that's insurance on the $17 trillion US economy. If you buy a bond denominated in Australian dollars, it's insurance on that far smaller economy. However, if something goes wrong in a large economy like the United States or Japan, it's far more likely to affect the rest of the world than a crisis in a country such as Australia or Egypt. As a result, the currencies of large economies tend to gain value when times are bad. Bonds issued in the currencies of larger countries are thus more expensive and hence offered at chronically lower interest rates. The onset of a currency union, moreover, lowers interest rates in participating countries, and stocks in the non-traded sector of larger economies pay lower expected returns.